Hello, greetings. Welcome to Dividend Blasters. This is our 114th video, and our topic today: invest in tomorrow's energy and get today's investment gains. How are we going to do this? Through the brand new ETF by VistaShares. It's a VistaShares Electrification Supercycle ETF, POW or POW. I'm going to talk about this brand new ETF. It is launching today, October 28th, 2025. First, a little housekeeping. What I say is not financial advice. The purpose of this video is for information and education. It reflects my own opinions, research, and experience as an independent investor for more than 30 years. So do your own research and due diligence before making any financial investment decisions. So, let's talk a little bit about POW, the VistaShares Electrification Supercycle ETF. I got this right from their fact sheet on their website. And a couple of primary objectives: offers investors a strategic avenue to participate in the electrification supercycle, which is going to reshape multiple industries worldwide. This ETF seeks to get long-term capital appreciation for its investors. So this is a very much an actively managed ETF. It will be. And the team that manages it, like all their other ETFs, they're experts in the industry, in the investment industry, managing ETFs. But they also have industry experts in the power industry, in the electric utility industry, that really, what you need to be successful here is to really understand that value chain that's part of this whole electrification supercycle process, because they're looking to extract as much value as possible from the companies that they're going to invest in. And these companies, I'm going to refer to them as picks and shovels, because basically the picks and shovels are the performers that are going to be enhancing, rebuilding, expanding, making more resilient the infrastructure, the power infrastructure, the power grid, the electrical power grid. And that's the infrastructure. So very, very important. And that's how this has to be a very actively managed fund. You really need to have experts that understand the ins and outs of the industry, what the major players are doing, what value they're adding, who's delivering more, who's not delivering, where you want to invest in. These holdings are going to fluctuate. I'm going to share a handful of them. I'll share the top 10, and I'll talk a little bit about maybe five of them, just so you can kind of get a sense of what they are investing in. So you'll know as an investor what you can expect. So, what are some reasons to consider investing in this fund? The growth potential is going to be huge. There's estimates that electrical or electricity consumption over the next 15 years is going to go up anywhere between 35 and 50%. And what's driving this? Uh, Artificial intelligence. Uh, Artificial intelligence is the thing. If you've been watching the news the last 5 years, you know AI is the thing. You need to be exposed to artificial intelligence. Well, for artificial intelligence to be successful, you need energy, you need power. And, to do that, you need data centers. Well, to run the data centers, you need energy, you need power, you need a power grid. You need an electrical infrastructure that is solid and resilient. And to be quite honest, our power grid has seen better days. For years, uh, it should have been upgraded, probably decades. But it's that investment and that needed activity has been deferred and delayed and deferred and delayed. We're at the point where it actually has to be done. And why now? Well, it has to be done. There's a national security reason for it. If the power grid goes down, we're all screwed. Okay, but um, the technology has caught up where it absolutely demands uh, that this electrification super cycle happen. And a big part of that super cycle is to upgrade the power grid. So there's going to be huge growth in that. And that's basically not just AI. AI is driving it. The electrification is part of it. But there's going to be huge industrial growth. Other companies that are going to be part of it. Uh, Building new data centers. There's construction companies that specialize in data centers. I'm not going to get too much into that, but really, there's just huge ripple effects across multiple sectors in industries. Um, what's another reason to consider investing? We're at the very beginning of this super cycle, this electrical energy uh, transition, if you will. And it's going to go on for a while, and it's going to get bigger. And so that means that the work that needs to be done by the performers in the industry, the picks and shovels, is very likely going to increase. The investments are going to increase, and that's good for them. It's good for VistaShares. It's good for this ETF. And if you invest in this, and I'm looking closely at it, I may very well invest in this. It's good for us investors as well. VistaShares, they got a handful of ETFs, two in the super cycle family. One is an AI one, and now this one, this electrification super cycle. And then they have, I want to say, four income-based ETFs, and I've done some videos on them. And then there's a leveraged slash momentum-based ETF. Um, it's called it's part of what we call animal spirits. It's called Wild, and that's also a growth ETF. So I'm going to talk a little bit more about the growth ETFs, uh, just for context purposes. But this company, VistaShares, they have really smart people uh, that have been in the investment industry for a long time. We're talking 20 and 30 years. But they also have very smart people that are very plugged in to this sector and this industry. They understand how the energy sector works, and particularly electrical utilities, electrical power companies, companies that engage in the power grid. And so it's so important that you have folks that really are plugged in to how this whole value chain will work as part of this super cycle. Because remember, their objective is really to extract as much value as possible for the investor from this value chain throughout this super cycle. So you really need to know how this works, and who's delivering what. It's so critical, so important. A little bit about the super cycle. So a super cycle is a little bit different than a business cycle. And some folks might say, "Hey, it's what's the difference?" Well, super cycles are prolonged, multi-year or even multi-decade periods where the demand for a set of commodities or assets rises significantly. Think of commodities like oil or gold, or power. So important. And we could go down the list, but you get the idea here. There's absolutely, this is a super cycle. We saw this happen in China, and I'll talk about this a little bit later in the early 2000s, where they went through this mass industrialization of their major cities in the early 2000s, and they became very urbanized in their major cities. There was a super cycle there around metals, as well as around construction materials and labor. That was huge, and that went on for years, and it's still going on. Slowed down quite a bit. Um, and so these things are also often driven by large scale shifts, economic shifts, technological shifts, and structural shifts. We see this electrification super cycle really all of those three. How is it different from business cycles? A business cycle can be 1 or 2 or 3 fiscal quarters. This can go on for years and decades, so much longer. And also, they can absolutely be a boom to investment um, dollars in a sector or in multiple sectors. And I'd have to say that if I was to look at, what sectors are going to be um, part of the initial boom, they're all going to be impacted at some point. But right now, I would say the industrial sector, the energy sector, um, and probably the information technology sector, and a little bit with the materials sector. But ultimately, all 11 sectors will be impacted, and they'll be benefiting from this super cycle. It's going to take a little bit of while, though. What are some key characteristics? Long duration, as I already said, they can go on for years. Some can go on for 10 years, 20 years, 30 years. They're driven by major trends. So industrialization, I already mentioned, China, urbanization. Here with this electrification super cycle, technological breakthroughs. AI is really pushing this to happen. It absolutely needs to happen. Others, population growth, sectoral transformation. Also, that's here as well with the global electrification, if you will. Uh, it's commodities focused, most often related to commodities like oil, metals, energy, and sometimes agriculture. And these will always be accompanied by increased investment. To get a super cycle done, for it to be effective and to be successful, it takes investment dollars. And at the very beginning, you got to have the infrastructure. And those industries don't work for free; they want to get paid. So here we're looking at the picks and shovels. They need to get paid to do their work on the infrastructure. Recent examples, I already mentioned China. I won't say it again. Second one I have highlighted in pink. This is what we're going through now. It's the electrification supercycle, and it's already underway. And it includes electricity, batteries, grid infrastructure, so important, and energy technology. These are all in high demand due to this global electrification supercycle. And there's also efforts around decarbonization, and that's really more along the lines of clean energy, renewable energy. I'll talk a little bit about that. I'm not going to get too much into that. So really, I'm talking here about why you do this, and there's really, I think, an urgent need to invest um, in the super cycle, and I think this ETF is probably a decent way to do it. And there's a handful of drivers of this global electrification. I already touched on a couple of these. So technological advancements. Um, there's alternative energies. They're also becoming a little bit cheaper. Um, solar, wind, hydro, but also battery storage, smart grid technologies. These things are becoming more important and critical to this large scale electrification. And they're becoming cheaper ultimately. Uh, Energy demand for growth. I think that this is really huge. I already talked about urbanization and economic development. We're seeing this happen. It's going to happen more in emerging markets. So the third world countries like in Latin America and the African continent, parts of Asia, um, but also I would say even more and more uh, directly related to us here in the United States is the rise of digital technologies. So, for instance, cryptocurrencies, um, but also that artificial intelligence, um, which is it's going to revolutionize everything that we do. But also cloud computing that's been around for a while, and to do all these things, to do cloud computing, you got to have data centers. To effectively do AI, you got to have data centers, and part of that is you got to have a resilient robust power grid, and that infrastructure uh, on and around the power grid is so important for it to be there. And it's going to increase the demand for electricity. Yeah, I listed vehicles here. You cannot go outside of your house today or get on the road without at least driving past a dozen Teslas or other electric vehicles, or also seeing somebody, um, on their cell phone, which is powered ultimately through, a tower, a cell tower, which needs power to run. Um, and also tablets. They're everywhere. Well, this is just going to increase even more, especially with AI. There's just going to be a continued proliferation of mobile devices, wireless communication. It's just going to continue, and so we need that infrastructure to continue to grow and become more resilient. Another one here, and this is really more in the geopolitical dimension, is energy security and independence. Countries, they want to wean themselves from dependence on getting sources of energy from other countries, maybe from the Middle East, maybe from not so friendly countries. Fossil fuel, uh, imports. They want to wean themselves from that, and you can do that through a couple of ways. You can have domestic production, which we're doing here in the United States with oil and natural gas, and that's a good thing. And I'm not going to go ahead and bash fossil fuel. I think it's a key source of energy. Um, but we have to have balance in our energy policy, and this administration is doing a really good job of complementing fossil fuels with other sources of energy, and also making sure that we will have a resilient, robust power grid. And this is happening already, and it's going to continue to happen. And then, of course, consumer preference shifts. People are choosing electric vehicles. You already mentioned you see them on the road. And then also renewable power sources. All this is really ultimately going to rely on a robust power grid, electrical power grid. I got this from VistaShares website, POW ETF, the VistaShares Electrification Supercycle, fueling AI industry and the modern grid. I like that. It sounds so cool. Here's a list of the family of different ETFs, and I see seven of them. Two are in the Supercycle family. I already mentioned they have an AI one. Uh, POW, the brand new one, which is launching today, is listed. They have four income based ETFs, and I'll just mention here, and I've done a few videos on these. Um, these all target a 15% distribution, about 1.25% per month, but they do prioritize long-term capital growth, which is really nice. And income-based ETFs that do that, they basically say we do not want NAV erosion, which I think is a fantastic thing. Not all ETFs do that. These guys do that. And then there is Animal Spirits Tactical Alpha ETFs, and there's one there that's wild, and that's the Animal Spirits 2X Daily Strategy ETF. That is a leveraged, momentum based ETF. And I've done a couple of videos on Wild. All right. So, reasons to consider this ETF. I already talked about the first couple, high growth potential. We're also at the very beginning of, this transition of this into this super cycle. We're in it, but we're at the beginning. Um, what I found also is that the holdings that I saw, you get a nice mix across the value chain, but you also get a mix of some international companies. So they're not all US based. A lot of them are, at least within the top 10, but some of them are from different countries. And you'll see a few of them when I show you, maybe six of them, six total of the top 10. I don't want to go through all of them. Um, and then also, it's a good way to get diversification across this entire value chain without having to buy all the stocks. Let them do the selection. These guys are the experts. And if you decide you want to scale up on a particular stock, study the ETF, look at the holdings, and decide, hey, this one has been performing very well. I want this one. I'm going to go in. Um, and they have a rigorous investment process. And the only way they can do that is to have experts, not just experts in the investment industry, but also experts in the power industry. I already covered summary and objective. You can read this, but I think I've hit these points pretty hard. A little bit more detail on the ETF. The expense ratio for this is 75 basis points. So for every $10,000 you invest, you pay $75 a year. It's going to pay an annual distribution. So you'll get a distribution once per year. And I could call it a dividend here because it's an ETF, but there is no options overlay strategy here. This is going to be fully replication and passing on dividends. Um, and that's fine. I actually would not invest in this for income. There's other ETFs that you can invest in with VistaShares. This one is for long-term growth. The ticker symbol, as I mentioned, is POW. It will be trading on the New York Stock Exchange. And it's actively managed. And it is launching today, the 28th. Already talked about the fund description. Here are the top 10 holdings. And I'll share with you some information on some of them. And you can go through these at your leisure later. But the top 10 are, and none of them are more than 5.3%. There's 53 holdings. After the top 10, they're all going to get a little bit smaller to fill in that 100%. But Hubble Inc. and then Delta Electronics, and it's a Thai company, Eaton Corporation, GE Verona, and it's the spinoff of General Electric, spinned off, I believe, a couple of years ago. Powell Industries, Quanta Services Inc., LS Electric. This is a foreign company. I believe it's from Spain. I don't know much about it. Prismian SPA. And that's all I'm going to read on that. Hyosung Heavy Industries, and then Constellation Energy. So I own some Constellation Energy. I don't own any of these others. I've been looking at GE Verona, and I've also been looking at Eaton a little bit. But I'm going to give you a little bit of just a deeper dive into a handful of these, just for your own understanding, so you get a sense of what these picks and shovels do. So the first one is Hubble, and this is their largest holding. And they design, manufacture, and they sell electrical and utility solutions in the U.S. and internationally. They have two operating segments: electrical solutions and utility solutions. This is a $23 billion company. They offer a dividend of 1.22%, and their PE is 24. And how have they done the last 5 years? And the reason why I'm showing you this is the fund here wants to get long-term growth for you. So let's see how the holdings have done over the last 5 years. I thought that would be pretty neat. Not a guarantee of how they'll do the next 5 years, but we do know that the demand for this work is going to go up. So for the last 5 years, they have delivered 200 and I want to say 218, 219% versus the S&P 500 is 103%. So more than double. Next one is Delta Electronics. This is the Thai company. And they research, develop, manufacture, and distribute electronic products. They have four segments: power electronics, mobility, infrastructure, and automation. And they have a whole list of products. You can read them. They offer a very, very small dividend. They don't even use they can't list the yield percentage. So I'm just going to read the dollarized amount. It's 1 penny per year. So you don't buy this for income, you buy it for growth. Market cap about 78 billion, and the PE is very, very high, which means they are selling at a huge premium. For $5.70 a share. So, I mean, dollar wise, it's fairly affordable. But look at the total return for the last 5 years. It's about 15 times the S&P 500, 1,485%. That's Delta Electronics. All right. Next one is Eaton Corporation. And they operate as a power management company in the US, Canada, Latin America, Europe, and the Asia Pacific region. And their major subsidiaries or operating units are Electrical Americas, Electrical Global, aerospace, vehicle, and e-mobility. Those are the major segments, and they offer a huge array of electrical products. They do pay a dividend. That dividend yield is 1.11%. The PE is 31. They are a $146 billion company. That is their market cap. That is Eaton Corporation. And the last 5 years, they have delivered 294%. So about three times the S&P 500. And then there's GE Verona. This is ticker symbol GEV. I've been looking at buying this. It's actually done very well. I probably wish I had bought it, a long time ago. But they're an energy company. They engage in the provision of products and services that generate, transfer, orchestrate, convert, and store electricity in the US, Europe, Asia, and the Americas, as well as the Middle East and Africa. Three major segments: power, wind, and electrification. They pay a dividend, very modest, 0.17%. And I'm not surprised. This is a very uh, uh, upfront capex type of a company. It has to be. Market cap is about 159 billion, not trillion. So seeking alpha, you made a little mistake there. 159 billion dollar market cap. PE is a little on the high side. It's 81. And how have they done the last 5 years? Actually, it's the last 2 years since the split off. 346%. So about 3.5 times the S&P 500. That's GE Vernova. Next one, POW Industries. POW Industries designs, develops, manufactures, sells, and services custom engineered equipment and systems. Principal products include integrated power control room substations, custom engineered modules, electrical houses, medium voltage circuit breakers, monitoring and control communication systems, motor control centers, switches, bus duct systems, as well as traditional and arc resistant distribution switch gears and control gears. So everything that I'm reading here, it screams off the page infrastructure, all of it, all 100% of it. This is a $4.4 billion company, so the market cap's quite a bit smaller. They do pay a dividend of 0.29%. The PE is 25. This is Powell Industries. And how have they done the last 5 years? 16 times the S&P 500, 1,642%. That is really impressive. Next one, Quanta Services. Quanta Services offers infrastructure solutions to the electric and gas utility, renewable energy, communications, pipeline, and energies in the US, Canada, Australia, and internationally. To me, that's the perfect pick and shovel for this. And they have a huge, deep background in infrastructure. And I'm just going to talk a little bit about the electric power infrastructure solutions segment. They do design, procurement, construction, upgrade, repair, and maintenance of electric power transmission and distribution infrastructure and substation facilities. They do installation, maintenance, and upgrade of electric power infrastructure projects. They do installation of smart grid technologies on electric power networks. That's huge. Design, install, maintain, and repair commercial and industrial wirings. Okay, so that's all I'm going to read on that. You can read more of it if you like. This is a $66 billion company. That is their market cap. They pay a dividend, 0.09%. Their PE is a little under 42. So what you're going to see is some of these PEs are a little bit inflated. They're selling it, I'd say, quite a premium here. Investors have been buying in. ETFs have been buying in because the PEs are high, but there is a feeling that the growth is there and the revenue and the profits are going to catch up because we know that the demand for electricity is going up. And obviously, when that happens, the demand to enhance and make more robust the power grid is also going up. And how have they done the last 5 years? Well, 634%. So about six and a third times the S&P 500. Quanta Services. That's ticker symbol PWR. Last one is Constellation Energy. I actually have some shares in Constellation. They produce and sell energy products and services in the U.S. They have five major segments. They're geographical, primarily Mid-Atlantic, Midwest, New York, ERCOT, and other power regions. And what do they offer? Electricity, natural gas, energy-related products, and sustainable solutions. They have, and I'll give you a metric here because they give it 31,676 megawatts of generating capacity, consisting of nuclear, wind, solar, natural gas, and hydroelectric assets. They serve distribution utilities, municipalities, cooperatives, and commercial, industrial, public sector, and residential customers. This is a $122 billion company. They pay a dividend, 0.4%. The PE is 41, also trading at a premium. And how have they done the last 5 years? 862%. So about a little more than 8.5 times the S&P 500. So those are the handful of holdings that I wanted to share with you. I want to talk a little bit before we close, just on how VistaShares manages their growth ETFs. And so I mentioned there is another supercycle ETF that's the artificial intelligence one that's ticker symbol AIS. And then there is the leveraged ETF, Wild. And you can see the various expense ratios. This one here, POW, has the same expense ratio as the other supercycle ETF, 75 basis points. Assets under management for AIS is 88.8 million. Not bad. They've been operating for about 10 months. We'll see how POW does. And you can see the total return for the last year. And I'm using year because these have basically been performing more than 6 months for the most part. And I'm comparing them to index fund ETFs. So VOO, which is the S&P 500, and QQQ, which is the NASDAQ 100. The artificial intelligence supercycle is killing it, 60%. While, which is the momentum-based leveraged ETF, is 73%, also killing it. So that's pretty impressive. I would expect nothing less, and I will expect nothing less from POW. And folks, that is it. I thank you for sticking with me. I hope you found this to be useful and informative. And if you found this to be so, give us a like, share the video with a friend, hit the notification bell so you'll be notified of the next video that is released. And we'd love for you to subscribe to our channel here at Dividend Blasters. We're on multiple platforms. We're on X, Instagram, and Facebook. You can see the QR codes and the handles. And as a friendly reminder, as an affiliate partner of Seeking Alpha, I can extend subscription discounts to new subscribers. Premium membership, you get access to insightful stock and ETF analysis and updated stock and ETF price quotes. And you'll get a discount. And I want to say $25 as well as a 7-day free trial. If you don't like it after 6 days, you can cancel. No harm, no foul. Alpha Picks, it's another membership where you will get 2 free picks every month from their spectacular investment analysis team. $50 off for Alpha Picks. I subscribe to both of these. I love it. And these picks that come out of Alpha Picks, they kill the S&P 500. You can see the links there. You can read more about the discounts, and you can sign up. You got the links and you got the QR codes. A little bit more information on the discounts. I've already talked about it. And you know what? If you want to get them both, you can get the bundle. You'll get a $159 discount. I pretty much have the bundle because I own both Premium and Alpha Picks. I already mentioned we're on different platforms. Until our next video from Dividend Blasters, have a wonderful day. God bless.